I've been asking myself a question. Why do some people retire with financial freedom, but others just struggle and scrape to get by? I started working on this question in 2010, and I've learned quite a bit. And now I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hey, everyone. My name is Brad N. Reed, and I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Welcome to this episode of Financial Fountain of Freedom, where we're going to talk about some simple strategies to optimize your mortgage. Because for most people, the mortgage is their biggest monthly expense. And if you are trying to build your financial fountain of freedom, it'd be nice to have a few extra bucks from the way you have structured your mortgage. And a few extra bucks could be a couple of hundred a month, maybe tens of thousands or hundreds of thousands over the lifetime of your mortgage. Next time, I'm going to jump into the stock market, and there's a lot. So, yeah, we're going to have several weeks where I talk about how to do cool stuff in the stock market, which I'm going to talk about next. Now, my screen's not advancing. There we go. The big picture, everything that I'm creating is going to be free classes on how to be good, which is get out of debt, align your mind, body, and spirit. You are the average of your five closest people is one of my favorite teachings out of that. And if you've ever gone on vacation or you've gone to hang out with people that maybe they party a lot or maybe they spend money a lot, then you get tempted into doing that too. So be sure that you are conscious about the five closest people and that their financial future is the same financial future that you're trying to build. Third one, where we are at, I had Ken, the hype man, or no, the hype man Ken. I had a meeting with him and said, bro, you should call that dominate. So I'm going to thank you, hype man Ken. Check him out on social media. Maybe he can help you too. But dominate, right? This is all about learning to invest for yourself, build side businesses, grow many streams of income. And then stage four is when the money is coming in faster than you know how to spend it. How do you live a life of fulfillment? Money does not buy happiness. So how do you be happy? How do you give generously to your community? And how do you sustain the financial fountain of freedom that you've built so it doesn't run out? So over the next several weeks, we're going to talk about the things that I have learned since 2010. Tonight is mortgage strategies. Then next, I'm going to get into the stock market, talk about ETFs, dividend stocks, some option strategies. Did you know you can buy insurance on the stocks that you own? You know you can sell insurance on stocks that you don't own. You can lock in wins, guaranteed. And I don't mean by selling. There's a way to lock in wins where you are protected on the downside and you get paid to sell at your target. And I'm going to make that a little bit better. You can get paid every month that you don't sell at your target for stocks that you own. And if there's a stock that you do not own and you want to buy it, you can get paid every month that you don't buy it. And then when you do buy it, get paid to buy at your target. So there's some cool things that to know just to give you an extra couple of percentage points on your stock performance. But as you can know, over the lifetime, that'll add up. All right, then we're going to jump into multifamily. And we're going to talk about valuation of commercial real estate and how wildly different it is than the valuation of residential real estate, because you can do strategies where you force the appreciation of commercial properties. Also, we'll get into market analysis and underwriting, and then we'll expand that into private equity and energy. So all that is coming. Come back next week. Part of the slide didn't load. Try this. Wow, because this is a very technical, high video demand slide, I guess. Folks, this is not financial advice. This is for education and entertainment only. Should you need such personalized financial advice, please seek a competent and licensed individual in your area. There is no offer to buy or sell any security. There's no investment advice. There's no tax advice. There's no accounting advice. There's no legal advice, and there is no mortgage advice. We will share some strategies with you that may or may not apply to you. Please seek a competent mortgage originator should you want to implement and talk about these. And I got an awesome one to introduce you to. So the last several weeks, we are going to summarize in a simple 4-step strategy. Interest rate matters. You got to get the interest rate that works for you. Inflation increases the cost of living. Inflation is working against you. In a typical 36-year retirement timeline, the cost of living is expected to quadruple. You need to plan accordingly. So I built a calculator that includes inflation. You must calculate your required inflation adjusted rate of return and then compare that to your current strategy. If you're getting the performance that you need, awesome. But if not, try some of the strategies that I'm going to be teaching here. It's the difference between a financial fountain of freedom and a retirement dumpster fire. So this is where you go get that calculator. I'm going to move on quickly. So pause this video if you have not gotten that already. And remember, calculate your desired rates of return and structure a great portfolio that is diversified, non-correlated with asymmetric risk reward. And the buckets that I like are the asset allocation. I focus on real estate as my biggest, and then private equity. Stocks are certainly part of it, public equities, energy, and alternatives. Need to be sure that it serves your needs for cash on cash if you are in retirement, and equity growth if you are not in retirement. So, Indomitable Horizons Funds has investments now. Swing over to indhrs.com if you're interested in learning more about how we are building a portfolio that is diversified, non-correlated with asymmetric risk reward, focusing on real estate that delivers both cash on cash and equity growth. Groovy. Today is the special day. I have Leanna Buck on the line with us. Leanna is a mortgage originator and she has a heart of gold. Leanna reached out to me back in November when there was a government shutdown, and in our area, they were talking about SNAP benefits that were going to go away. SNAP benefits are like food stamps. And Leanna, do you remember how many hundreds or thousands of families were in need? Basically, they said, hey, it's doubled and it's growing. But
Can't remember exactly.
yeah, okay, you don't remember exactly. Yeah, it was a lot, and we got a lot of food very quickly, teaming up. Leanna's that kind of person. So she puts the client first, which I do as well. And so Leanna and I are referral partners because of that. And Leanna, I'll let you take it from here.
Hi, thanks for inviting me, Brad. I've been with JP Mortgage Company for almost a year, but I have lots of banking and financial counseling experience. So, originally from Kentucky. I'm sure you'll hear that here soon. But I've been in Avon for 10 years. We have two little ones, as you can see in the picture, and they're still about that size. So it's hectic around here sometimes. So the next slide is going to talk about some of what's on the first one. So I'm not going to read them all word for word or anything. We'll just discuss. If you have questions at the end, we can go back to it. But this is talking about how your interest and your principal is broken down, which you probably know a lot of that kind of stuff. But if you look on month one, your interest is 2,500 because most of your interest is in the beginning, less principal. So whenever you do a 30-year mortgage, you're paying a lot of that interest up front. And then if you look at the calculation, year 15, the interest gets smaller and more starts going to principal, but it takes a long time to get there. So if it works for you to do a 15 year, then you're going to save a lot of interest. This says that the interest that you pay in 30 years is $579,000. Um, in another slide, we talk about the differences in them and how you can bridge that gap. Here it is. So, a 30 year and a 15 year. This one is comparing a little bit with the rate as well. But the monthly payment for 30 years, 29.98. The other one is almost double. Well, not double, 1,000 more. But your payments, if you can see, are much greater for 30-year. Your interest is a lot more. So interest as percentage of your home is 116%. When the 15-year one, the interest that you pay is 47%. So it really does save to do the 15-year if you're able to swing it with your monthly payments and other expenses that you have. Shop your rate. Most people don't. So This says to shop like five different places. There's four different lenders on here just to show you a good example of how the rates can be a little bit different. I have already helped just this past month two people from going to just a regular bank. Nothing against banks, worked there a long time, but mortgage brokers have a little bit cheaper interest that they can get. So the one the other day, let's see. One bank gave them 8 or 9%. The other one did 6.8, and I got them at 5.625. So,
Wow. So,
so
Leanna, just before we go on from this slide, you can shop for people, correct?
yeah,
Yeah.
I have multiple lenders that I look at, and there's like the top two or three that I kind of keep with because their rates are always the cheapest. Their customer service is great. So if I ever have a question or I need something, like I was getting an email an hour ago while we were playing in the floor with my little ones. So they work all the time like I do because I still kind of stay home with the little. The other one's in school, and when my husband comes home after he's done with his job, then I get to work a little bit more. So it's flexible so that I don't have to put him in daycare and stuff. So I like it.
That's
So
beautiful. Don't certainly don't want to have to put your husband in daycare. But I
I
just
know.
want everyone to know before we go on that Leanna is a one-stop shop, right? You don't need to call different banks and different brokers and different this and that. You call Leanna and she'll do all the work for you.
Yeah.
Okay, I'm gonna go back on mute because you're killing it.
Look, I do all the loan processing too. So you can see that on like closing cost. So I can normally beat other people's closing costs too. And I've done that with two other banks just the last few weeks as well. So it pays to get them to give you the quote and give you those fees and stuff too, so that you can kind of see exactly what you're paying. So on this example, it's talking about just shopping the different rates, what your monthly payments could be, and all of these are 30 years. But you can see as you get cheaper interest rates, you pay a whole lot cheaper interest, and your payment, some stay close to the same based on if what your, um, principal, what your sales price is, what you're buying the house for. But okay. Ask the seller to buy down your rate. And that is a good way to, if you get closing costs or seller concessions and you don't need all of them because the costs don't cost as much, you can say, okay, well, with that extra $1,000 that was left over, I want to see if I can buy my rate down. So then you can use those seller concessions to help you buy your rate down too. So if you pay the full price or even over and ask the seller to pay, your mortgage discount points are done at closing. 1 point is cost 1% of the loan amount, and it lowers it by 1/4% each time. So in this example, the interest rate is 6%, or you can do the $10,000 price cut, or you could buy 2 points, which in this case is 0.5%. Which one would work for you is based on how, your finances are, or how much money you have in the bank for savings, and which one is more important. Are you able to buy down the rate at a cheaper price because of extra seller concessions, or maybe the rate buy down is pretty cheap? There was another team member had one not long ago, and the rate buy down for like the next 0.5% was only like $300. Well, the other day when I looked, the rate to get it a little cheaper was like 8 or 900. So it depends on the day and when you lock it all in and all that kind of stuff. So it doesn't hurt to ask, hey, what if I wanted to do a 0.5%? Like how much extra would it cost? Because according to this, buying your rate down a little bit saves you 159 a month and 57,000 in interest. Tip 4, pay every 2 weeks instead of monthly. So here's some calculations for that. If you don't do biweekly, because sometimes the bank or mortgage lender will have you pay extra to do that, or they might not be able to set it up. You can do just extra to principal each month. So you can divide it out. I thought it was divided on here. Anyway, whatever your monthly payment is, divided by 12, add that amount to all of your monthly payments all year, and you'll pay an extra payment and get it paid off quicker. So if you look, if you paid monthly, then your total interest is 579,000 and it's still the 30-year term, but biweekly is going to make your term only 24 and a half years, and you're saving 124,000 in interest. So even if it's $100 a month or a twelfth of the payment every month, a little extra every now and then helps, even if it's, Christmas money or tax money or a bonus or
Or
throw
investing
for
in a deal with Indomitable Horizons Fund.
yeah. So anything that you can throw at your mortgage for principal can save you interest and save you time, and then you'll have a paid off mortgage soon.
Yeah, and I just want to jump in. The whole point of these strategies is that you see how much money that you can save over the lifetime, and then you can use that money to build your financial fountain of freedom.
Right. This one is the smart refinance strategy. So people are talking about refinancing now. The rates are getting better. I'm getting those emails from my lenders every day, every few hours. Rates have improved. So, but if you are wanting to refinance, you need to kind of check out your break-even point. So, how much are the closing costs going to cost you to do the refinance? What's the monthly savings based on what you're currently paying and your new payment? And then how many months does that equal out to be? So in this case, their monthly savings from their current to new payment is $314. Closing costs are around 8,000. So their break even is 25 and a half months, so around 2 years. If you're going to stay in the house longer than 2 years or up to 5 years, then it might be a great idea to do it. Sometimes you can roll in that 8,000 into the loan too if you have to, but that may not help much. So you want to be sure that you actually have the closing costs available to do it. Say it actually saves you money in the long run. So on the other side, the rule of thumb is your rate needs to drop at least 1% or more. You need to plan to stay in the house at least 3 years past your break-even point. So in that case, it was 5 years that I said. No cost to refinance available. So rolling cost in, like you could do that or you don't have to. Depends on where it kind of puts your payment or length of time and how you really want to try to save it. Your credit score has improved significantly. So maybe when you first got your mortgage, you were 660, but now you're probably a 750. So you're going to get a better interest rate and better pricing for that too. And restarting the 30-year clock isn't what the refinancing is going to be for if you're wanting to save the money. If you're going to move in 2 to 3 years, won't help you either. So refinancing to 15-year will give you the bigger payment and the better savings. And then if you keep the same term with the lower rate, you can still do the best of both worlds. Eliminate PMI. I have to explain this all the time. You're paying for nothing, which I try not to say that, but it is true. So this is to protect the lender. It doesn't protect you. The homeowner's insurance is different than the private mortgage insurance. So on a $500,000 home, the PMI is around 0.5% to 1.5% of the loan. Generally, it's 0.55 to 1% generally. So that's $150 to $400 a month. So to get rid of your PMI, you can say this a couple of different ways. I normally say it differently than what I have on my slide here. But you can put 20% down on the house up front. Normally that's for conventional and things. Then you don't have to worry with PMI. But if you don't have the 20% down, then you have to pay the PMI until your mortgage gets to the 80% loan to value. And then you can request it to be taken off at 80%. It automatically falls off at 78%. So this says when you reach 20% equity, and I always just say when you're at 80% loan to value. That's just what I'm used to saying. VA loans and USDA loans, they do not have PMI. So that's the positive for those. So on the other side, if you're able to put 10% down, which in this case would be 50,000, your PMI would be 250 a month. So then Your equity after 1 year would be the 50,000 and any appreciation or thing that you got. And then the PMI would add 3,000 a year to what you've had to pay. But if you can do the 20% down and you have the 100% instant equity plus any appreciation after that year, then you've saved that 3,000. You didn't have to pay any extra for it. So always better to save for that new house so that you have a better down payment. 7 is use your equity wisely. So smart uses of home equity is to fund investment property with Brad. Fund investment property down payment. Your high return on investment home improvements like the kitchen and the bath. We just redid our bath and it's been the best thing ever. So it'll be fun to see how much that bath is going to give me for my ROI. Pay off high interest debt, any kind of credit cards, especially when they're 20% interest rates. And speaking of paying off debt, you can start with high interest ones or you can start with low balance ones. As long as you get those things paid off and you start to improve your score and your, oh, I can't think of what it's called, lower your credit limit or whatever your balance is so that your limit doesn't look like it's maxed out. Bridge financing for your next investment, start or grow a business, fund education with a strong ROI, or emergency fund so that you can keep that for emergencies. And then other things you shouldn't do with your home equity are things like vacations and luxury travel. Even though it sounds nice, then that's just very short-lived. Cars, boats, toys, so anything that's depreciating. Consumer debt, you'll run up again, so be careful with those, and credit cards. Stock market speculation, be sure you get, an experienced person for those things. Funding lifestyle inflation, gifts to family without a repayment plan, and anything that doesn't generate a return for you. Here's where we just combined all the 7 tips and gives you like a full picture of what we've talked about. So worst case is your 30-year mortgage at 7% and you didn't shop around, so you could have gotten it at 5.625, but you didn't. Monthly payments only, not paying any extra, doing less than 20% down and no rate buy down. So it talks about the interest paid here and PMI costing 5 years worth of 15,000. And then best case is you shopped around. You got a 15-year mortgage instead at 5% because 15-year mortgages are usually a little cheaper than 30, and you shopped your rate. Biweekly payments or just extra every month, either one works out. Doing your 20% down so you don't have PMI and extra cost. And the seller bought down your rate at 0.5%. So you saved 190,000. You didn't have to worry about PMI. So you made out like a bandit there. Your mortgage action checklist. This just talks about things that kind of already talked about. So doing a 15-year mortgage is always better than 30 as long as it's good for your finances. Shopping multiple lenders, the seller buying down your rate, biweekly payments, refinancing, and if it's good for you or not, getting rid of that PMI as quickly as possible and using your equity in a wise way. So if y'all have any questions, I am open for that. My phone number is listed here. My email is listed as well if y'all want to jot that down. If you have any questions about anything or if any of your family or friends need anything, I'd love to talk to them.
Thank you, Leanna. Oh my gosh, I capitalized the A on that one. I have a friend named Deanna, and her A is capitalized, but yours is not. I
No,
apologize.
it's not. I won't hold it against you this time.
All right. Next time I'll buy you a cup of coffee.
Okay.
Where am I I'm trying to go this one. So one thing that I really liked about this slide is that 1, 2, and 3 are pretty much before you buy the house.
Mhm.
3, 4, and 5 can be done after you buy the house. So if you combine 3 and 5, right? If you're going to do a refinance, maybe you have a little money in savings that you want to do to buy down your interest rate. I know for my family, when the interest rates dropped uh, at COVID, we switched from a 30-year to a 15-year and still got like 1.5, maybe 2 points lower on our interest rate. So it was a slight bump up in our monthly payment, but a significant amount of savings over the remainder of the lifetime of our loan. And we're, yeah, I guess a few years from having it all paid off because we made that move. So even if you have already purchased your house and you have your mortgage, there are still some strategies that you can use to get it done sooner. Now, number 7 there, use the home equity. That one has a little bit of a bitter taste in my mouth.
Yeah.
I left it there because AI put it there, and I was like, well, everyone has to make their own decisions for what's right for them in their own time. For me personally, remortgaging my house or taking out a loan against my house, or I don't know, anything, I just don't like that. I don't like the idea of risking my house on what were some of the things like
And boats.
home improvement. Yeah, I'm not going to risk losing the whole. But on that one, if it improves the value of the home more than the cost of the renovation, and maybe you're going to go sell it, then maybe that is a wise thing to do. Paying off high interest debt, eesh, I sure would hate to risk my home because I got a few too many sushi dinners or I went on too many vacations. But anyways, I won't go through pick this list apart. But number seven,
Mhm.
number 7 is where an expert like Leanna can help you out. So call Leanna, email her. Don't capitalize the A, either A. Um, so Leanna, thank you so much. Any parting words for those? Oh, and here's something. Uh, where do they have to live or be looking to buy in order for you to service them, for you to help them?
Anywhere in Indiana?
Okay. Just
Yeah.
in the state of Indiana?
Yeah. And I have my teammates in Kentucky too. So they can do Kentucky or Indiana. So
Okay, so Indiana
um,
or Kentucky, call Leanna. Now,
mhm.
Leanna, what if they live in California or Florida or someplace like that? Do you get any money if you refer them to someone over there?
No.
No. Okay. So
Nope.
if you are not in Indiana or Kentucky, find someone in your area. And actually, Leanna, I'm going to put you on the spot. How do they identify someone like you in their area versus if they go to the bank and the bank is, probably going to offer them one product and they're not going to shop around? How do they find someone like you?
You can just Google mortgage brokers in your area.
So mortgage broker is the key term to look for.
Yeah,
Cool.
my title is mortgage loan originator, but I think they're called brokers or loan officers. You can kind of call them whatever, but it's actually with a mortgage company instead of like a bank.
Awesome.
Mhm.
Thank you, Leanna, for taking time out of your evening and time with your precious kiddos and family to spend time with us and to help people get to their financial fountain of freedom.
Thank you. Mhm.
Thank you, Leanna. Sean says thank you in the chat pane. Thanks for being here, Sean.
Thank you.
Okay, money mindset determines your financial future. So, how you think about money will certainly determine whether you reach financial freedom or not. So, be sure that you're working on your mindset as hard as you work on your money. And an interesting factoid just came to mind. So, I'm going to share it. I'm so old that I bought some books on investing and a real life bookstore. And I remember noticing that half of the books are about strategy and half of the books are about mindset. So think about that. Half of the books on investing for your future are about how you think about money, not whether you buy this deal or that deal, or whether you get this interest rate or that interest rate. It's working on what goes on between your ears. So listen to podcasts, read some books, work on your money mindset. Calculate your desired rate of return, and then go get it. You can pay someone else to do it for you, or you can be active if you want to pay for the courses, the mastermind. It's about like getting a grad school education. It takes about that amount of time, takes about that amount of money. It's a lot of work. Structure portfolio. That is the perfect blend of Ray Dalio and Peter Maluk. You want to get diversified, non-correlated with asymmetric risk reward. You want to get into private real estate, private equity, public equities, energy alternatives. That's how you're going to get diversified, non-correlated, asymmetric risk reward. Folks, do not forget that you learn 10% by reading and listening. That's what you're doing here. These presentations will get you 10% of the way. You got to discuss with others, and you're going to have to do it to learn the whole thing. So if you listen to these and you watch these presentations and you're saying, hey, there's something missing. Yeah, this is information, and you need to talk about it with professionals in order to turn that information into knowledge. And then you have to practice it in order to turn that knowledge into a skill. This is just information. Remember, education and entertainment only. It is not knowledge. It is not skill, which you need to build your financial fountain of future. So stay tuned. Follow me on social media, and I will help you discuss, and I will help you practice. Folks, thanks for tuning in. And as always, invest on logic, not on hope. God bless you.